Hello. Welcome to Tio Talks Money. In today's video, I will quickly go over my recent analysis I posted on my website, manolov.co.uk, of a company called Teleperformance. You might have not heard of that company, and it might not be a household name as they're called, but there is a chance you might have interacted with one of its staff members. Right, what does Teleperformance do? Teleperformance is a global leader in digital business services outsourcing. In short, they help companies achieve their business goals. They provide them with outsourced support, whether technical or customer service support. They advise customers on how to implement a certain strategy, introduce a new product, market that new product, or various other kinds of services, outsourced services. Now, company uh, company was founded quite a few years ago by its current CEO. But you know what? We'll get to that in a bit. Let's jump into the customers of the company. Okay, well, the customers of the company are governments, consumer good tech companies, hospitality, retail, energy, social media, all sorts of companies. It's a massive company that operates across 100 countries and has, I believe, around 400,000 employees on its books. So yeah, and remember when I mentioned that you might have dealt with one of its staff members? Well, very good and famous names the company works with is our Apple, Google, Amazon, Paribas, one of the biggest European banks, Barclays, Alliance Insurance, HP, Dell, Sigma, Humana, United Healthcare, just to name a few. They have 1,400 clients across the world, around the world, across 170 markets, and they operate with well, their staff speaks approximately 300 languages, obviously combined. So yeah, they're a big player. They're a leader in their sector, as you will soon find out. Okay, what are the sectors? What are the sectors they operate in? What their customers, what sectors their customers operate in is more accurate to say. As you can see, they're very well diversified. The media, entertainment, and gaming is a little bit on the high end, with taking almost a fifth or 20% of the split. But nonetheless, they are very well diversified, which is always a good thing. They have two segments: core services and digital integrated business services, which provides, as you'll soon find out, the biggest source of revenue, which is customer care and technical support. Basically, call centers, outsourced call centers. And then you have content moderation and related services. Customer acquisitions, yep, they help their customers acquire other companies. Again, very valuable experience and know-how. Digital marketing, as I mentioned, integrated complex back officers. I'm not going to read through them, but you feel free to have a read through them. In terms of share of revenue segments, obviously you can see that the core services and the digital integrated business services is the biggest segment by revenue and operating profit. Specialized services, however, has had a really decent growth, and it is showing some promising financial fundamentals, so something to keep an eye on. What is yeah, as I mentioned, we already covered that core services, biggest part of the revenue. Specialized services brings around 15% of revenue there. Okay, another thing I also mentioned is call centers, care, that is customer support, technical support. That is 54% of the revenue comes from that, which is not ideal. It is not ideal. But it is what it is. 54% is better than 90%. It's better than 70 and 60%. So we will take it as it comes. Management, in terms of management, this is one of the areas in which the company truly shines. As I mentioned, Daniel Julien founded the company in 1978, has been the CEO of the company since then. So, who else better positioned to run the company than its founder? It's really great to see what an amazing job he has done over the course of the lifetime of the company. But this is, long, long, long. This is what 20. That's 47 years he's been in business, that company. So that's pretty incredible. He's been the head of it, and it started. As far as I know, it started as a company, okay, you know, with 10 staff members in Paris, 1970, and now it's grown to be a market sector leader, and bringing in billions of euros of revenue and net profit. Another thing that is definitely worth mentioning is that looking through the other executives, they have been with the company for quite some time, which is something very, very nice to see. CFO, Deputy CEO, has been with the company for 15 years now. Chief Operating Officer has been in the company for 21 years. Quite impressive. Chief Innovation Officer has been in the company for 20, 22ish years. That's pretty impressive stuff. I can tell you that. Chief Client Officer has been in the company for 26 years. That's amazing. Another really important thing I believe everybody should consider when researching a company is how well executives are compensated, remunerated. And we really don't want a company splashing millions of euros in that case, or dollars or pounds or whatever on its executives. And it's important for the company to recognize that its executives are doing a good job, but we don't want them to be you know paid millions. At the end of the day, that comes out of our pockets technically, because it comes out of the company's profits, which obviously affects what our share of those profits are. And in this particular case with Teleperformance, we can easily see that the company is compensating them nicely, but nothing too crazy. 50,000 euro bonus for the executives. Now the CEO has been pretty nicely compensated, but I believe he deserves it. I mean, he's been the head of the company. He founded the company, and he's been the head of it for a very, very long time. All these things can be seen on the annual report of the company. So I'm not pulling these things from thin air. They are all available for you to double check and triple check if you decide. Now, how do we judge if executives are doing a good job? Well, first of all, growth of the company, growth of its revenues, profits, obviously. Free cash flow, the most important metric I focus on. But also, we want to know how good they are deploying their capital. And we can find that out by looking, for example, at their share buybacks. Right, let's start with dividends first. Dividends are not priority for me, but it's nice to see a company paying a 3.8% dividend, which that's can't say no to that. And it only represents 16% of its free cash flow, which means that it's well covered. It's not going to be cut anytime soon, unless the company decides to make a massive acquisition, I mean, it's not going to be the first time, so they have a way of financing everything. So yeah, if you're a dividend investor and you find 3.8% appealing, go ahead and buy it. It's not going to get cut, and it has a very good track record of being increased. And as I mentioned earlier, share buybacks, important metric. We all love share buybacks, I think. Uh, I personally love them as long as they're done at a reasonable price. Certainly, that's the most important thing about share buybacks, because you see companies that will get they'll buy back, they'll repurchase their shares at highest price their stock's ever been at, which is just crazy for me. At like ridiculous PE ratios, what we observe here is now the company's share price has been going down for a while. It's been under a lot of pressure for good reasons, which we'll cover in a bit. But it's been, I think they've had since 2020, they've had a drop of 70-ish% in the purchase price. I think their price was share price was up at the 400s at one point and down to €100 now. So massive drop there, 75%. And the good thing is that last year, 2024, the company bought back 6.1%. Apologies. They did not buy back 6.1%. They cancelled. So they've been buying back shares for a while. Obviously, the way it works is they buy back shares and they put them in their treasury vault. I mean, theoretical treasury vault. They hold them in their treasury, and then at one point they decide to cancel them. So they canceled out 6.5%, 6.1% of their total share capital last year, which doesn't really tell us much because we don't know exactly at what price they bought it, because we don't know for how long these shares have been sitting there when they were bought back originally. But one thing we can see is that what's that? That's the cancel another 4.7. No, that's combined. Oh, sorry, that's what I've. Oh boy, that's just I'm just describing here where they came up with that figure there. But what was that? Yeah, so they have confirmed in their Q3 report that since the beginning of 2024 they have bought back 3% of their total share capital, which is nice. I have to say that's nice. 3%. Yep. Because if you don't know how it works is if you own one share, one of 100 shares of a company, and each costs $1. So let's say the market cap of the company is $100, and the company buys back 3% in this case, 3% of its company. So you no longer own 1% of all shares outstanding, you own 1 point something percent. So basically, you are entitled to a slightly bigger piece of the pie. So you're not one of 100, you're one of 97. So that's how it basically works. That's basically one way of increasing the price, artificially increasing the share price of a company is buying back its shares, which is why every company can do that. The most important thing about share buybacks is that people or management buy the shares at a good price, good discounted price. And we'll soon find out if that's the case. In terms of 2025 forecasts, there's none available at the moment. In what is it today? Today is 21st of February. So in 6 days, on the 27th, the company will release its 2024 full annual report, full year report, in which they'll most likely give us a bit of an insight into what they think 2025 is going to bring. But in terms of their growth over 2024, their revenue grew between 2 and 4%. Sorry, I think that is sorry. In 2024 Q3, they had a little forecast to say that in Q4 they expect to see a 2 to 4% revenue growth, which is something. It's decent growth. It's nowhere near to what the sector forecasts are at the moment, which again that's another thing we'll find out later in my report. But it's still some growth. I mean, it's a competitive business. Even though they are the leader, they have the best performance metrics. They're still a massive company, and 2 to 4% growth is still it's not too bad. Okay, risk factors. Okay, well, like I mentioned earlier, biggest risk factor is AI, which I just don't believe it. I understand that people worry that with the improvements, with the recent improvements in AI, people worry that AI is going to replace call centers and basically take them out of business, make them, just too expensive for companies to hire and help them. Now, the good thing about Teleperformance is that they have and they continue integrating AI in their systems to help their staff be more efficient and provide better value to Teleperformance's customers. So I would be really worried about AI if Teleperformance were not taking advantage of it. And even then, AI will most likely never be able to, or not at least in the near future, be able to replace that human touch. And also, I have personally worked in a call center. My first ever job in IT was in a call center, and I can tell you that it would be extremely difficult for people to program AI because at the end of the day, people are programming, people are teaching AI how to think, where to look for information, and people feed it, data in order for it to learn. So I can tell you firsthand that it will be very difficult for people, nearly impossible. I cannot fathom our ability to teach AI well enough so it can replace second line support. First line support is like these chatbots you see out there. People see them and I think they're gonna replace humans, but I just don't see it. I just don't see it. I mean, AI can replace first line, second line where you have more complex problems. Very difficult. I mean, we people can't figure this stuff out. In terms of the mess some systems have, the way they're designed, the bugs, the software bugs that need troubleshooted. You need to teach AI to, to read and to fix all those bugs first before it can actually operate. I believe that's my personal opinion. Anyways, I spent a little bit too much time on that, but yeah, it is a valid risk, I believe, but it's really really overblown. Uh, and it does not justify the 75% drop in their share price, as we'll find out later. Second risk there, company is a serial acquirer, which means that acquires companies in order to grow and in order to penetrate other markets. Now, if opportunities don't exist for potential future acquisitions, then obviously that's going to impact its growth. So that's one thing to consider. IT and cyber attacks, data breaches and leaks. Obviously, that's a valid risk factor for a lot of company these days. I mean, we live in an online world where everyone and every company is interconnected with a ton of data. A company storing on their system. So it's just one of those things. Unfortunately, the problem with Teleperformance and other companies operating in the sector is that they will inevitably hold and have to store customer data. So, a potential data breach is going to cripple the company, and it's going to cause some, bad reputation, and it might cost them clients in the future. So that's a big risk to consider. Regulations, again, these companies are heavily regulated since they're dealing with a lot of massive amounts of customer data. So governments want to regulate them and make sure that they're doing their job right. They're protecting your data accordingly. Customers not paying their bills. I mean, yeah, I mean, in an economic downturn, obviously companies are going to be losing money. They might not be able to pay their bills. There's a bit of information I found in their annual report for 2023, telling us a little bit about how much money they're due and by how long companies are overdue and on their payables. Not a massive amount, but something to keep an eye on when 2024 annual report comes out. Reputation, obviously, we want you to have a good reputation. Good reputation spreads fast. Bad reputation spreads even faster and costs millions or billions sometimes. So we don't want our company, the companies we're invested in, to have bad reputation or do a bad job. Portfolio concentration, like I mentioned earlier, customer care, call centers, 50 plus% of total revenue, not 53% there, not ideal. Duration of contracts. These are renewed to between, like, basically they last between 2 and 5 years. So obviously clients who have the negotiating power for getting their prices dropped. You can predict the company's revenues only 2 to 5 years in the future. Not ideal, just one of those things. Exchange rate, obviously, they operate across different countries. So exchange rates can certainly impact their revenues. Economic downturns, as I mentioned, they do customer support, they do some marketing, and obviously, in it's only logical that customers will start cutting the cord as soon as they see that the economy is not doing well and they're going to lose revenue. Interest rates, again, that is going to cost the company more money as they try to finance their debt, or refinance their debt, should I say. Credit rating, again, I think they're triple B at the moment, which is not the best rating, but it is the second best, I believe. I think triple A, double A, triple B, or something like that. I mean they're investment grade, so that's all good there. Liquidity, if the company obviously can't afford to pay its cash, if revenues drop too much, then again that goes for every company. But I thought I'll just mention all these here. Right, performance metrics. Now we get into the gritty bit of the analysis. As you can see there, revenue's been going up very, very nicely. Revenue's been growing steadily every year. Their revenue's grown, which is nice. 2023, it slowed down a little bit. Interesting. Acquisitions, you can see they've had an acquisition 2014, 2016. They had something small here, another one here. Pretty much every year, but three over the past 10. So that's quite nice. Now, P ratio. You see, their P ratio average is, actually, I don't know, it doesn't tell me exactly, but I think average is around like 28-ish, because you have two big ones here. 28, 29, and they're currently trading at, as we'll find out, they're currently trading at 9.48%, sorry, 9.48 times their earnings, which is attractive. It really is attractive. But yeah, just one thing to consider. That really, I love me a bargain, so that sounds like a bargain price. But let's keep digging. Free cash flow margin, pretty decent. Last year 1370. Well, that's actually the highest. So their free cash flow margin has been growing, which is very nice to see. 2023. Now my data, I used QuickFS to get that data here, and it said that they had 1.1 billion of free cash flow last year. But on their annual report, sorry, that's not last year, that's 2023, purely because their 2024 report has not come out yet. But what I find interesting is the fact that their free cash flow on QuickFS is different than what was in their annual report for 2023. So, yep, that's one thing to note there. It says here 1.1 billion, but they actually reported 8.812 million. So I'm not entirely sure where this discrepancy is coming from, but I'll believe the company. Whatever the company says, then that's what goes. Return on invested capital. That's not too bad. That is not too bad. Dividends, again, if that's something it's up your lane. It's not my priority. It's nice to have. Dividend payout, as I've been saying, it's a third of their profits. So that's not a problem at all. That is quite nicely covered. No risk of getting that cut or removed. Competition is a big one. Obviously, we want to know who the company is, competing against for their their piece of the pie of the puzzle, for their piece of the pie management. Kind enough to share that in their 2023 annual report. You can see, obviously, Teleperformance, biggest piece of the pie. Second, Concentrics, and then a few smaller players there. Now, Found ever. They're privately owned. Not too much information on them. Had 4 billion in revenue. Not much else I could find. Private company. There's not much of the data is public. Atento is no longer publicly traded. They were delisted because they were basically not doing too well. Again, another privately owned company. They're Aulorica. As you can see here, these are not very big companies, so not a massive amount of their uh, pie. Not a massive amount of the pie is going towards their revenue, so that's all good. Now, basically, company has three other competitors. There are Concentrix, TELUS, and TTEC. Concentrix IPO'd in 2020, so not as mature company. I mean, the company was founded in the 1990s or something, a long, long time ago, but it was held by a few other companies. It was bought by a few other companies, and then finally went public in 2020. So we don't have a lot of financial data there for them. But other companies are TELUS, TTC. What do we see now? Well, we can easily see that Teleperformance is the biggest by market cap, biggest by revenue. They have probably the best. Well, I wouldn't say the best because clearly you can see Concentric has 27% average, but that's not over 10 years, that's over 4 years. TELUS as well, they had negative earnings last year, so I don't know how well they are doing. And Teleperformance, very reliable growth, 13.34% annual growth rate over the last 10 years. So that's always nice to see. Teleperformance has the most free cash flow. Again, these are the 2023 figures purely because 2024 is not available yet, but their revenue will be their free cash flow will be even higher this year. Current PE for 942, that is very, very nice and nicely covered. Nicely covered. What am I even saying there? It's a nice low PE, very well under the 10-year average, as you can see there. What else do we have? We have the 10-year average PE, 10-year average free cash flow margin, nicely above the other cash flow margins there. You can see TELUS had it looks like they had a better margin over the 10-year period, but they had negative earnings, quite spotty. Free cash flow goes up and goes down, so I don't know, a bit risky. That price to free cash flow, 729 again. That is using FY 2024. Like that was mentioned earlier, you see 812. That's their cash flow in 2023. 2024 is going to be closer to 900,000 euros. Dividend yield highest from all the players. Net debt to EBITDA, that is the lowest from all those companies. That is quite nice to see, considering they're all serial acquirers, and that's how they all grow. 10-year average return on invested capital, highest from all the players. That is very nice to see. So in general and overall, Teleperformance has superior performance metrics compared to its competitors. Sector findings is found that report online. Grants View Research. They've researched the sector, and that is the business process outsourcing sector. Business process outsourcing sector. They've researched the market, and they forecast a 9 to 10% annual growth rate, which is quite nice, all the way up to 2030. So that's for the foreseeable future. So that's very, very nice to see. It will give us a decent idea of what we would expect the company's growth rate to be over the next few years. It's currently 4%. We'll see. It's 27th of February is a very important date for Teleperformance. That will give us an idea of how well they'll be doing over the next few years potentially. Again, companies grow by acquiring other companies. That's quite nice. Customer service segment dominates the market. 23% of the whole market. That's okay. That is quite interesting. It's anticipated that the training and development sector will expand. Okay. Obviously, we want to keep our staff trained up and up to speed with the latest advancements in technology. So that's interesting. A massive amount of this market revenue comes from North America. Again, understandable. Apple, Amazon, Google, that's where the money comes from. Now, the important bit, valuation of the company. Now, we saw quite a few risk factors there, right? So, what I think is reasonable to do when valuing Teleperformance stock is to be conservative. Just be conservative. We don't know. We don't know what's going to happen. We never know what's going to happen. Nobody can predict the future. So best thing we can do is second best thing we can do in predicting the future is obviously be conservative, be careful, and we're going to use conservative prediction. Assumptions. So here's now we're going to be doing a free cash flow analysis. A discounted free cash flow analysis, which I believe is the base way of valuing Teleperformance, since it's a cash generating company, and cash is what we like. So, in order to figure out what their 2024 free cash flow is going to be, we're going to do a few very simple calculations. We know that their revenue in 2023 was 8.345 billion, and they predicted that their revenue for 2024, and confirmed that prediction in Q3, that their revenue will have grown by 3%. So easy to assume there. We multiply 8.345 by 1.03, and that gives us a figure of approximately 8.6 billion. So we think that they're going to make 8.6 billion euros in 2024. Now from there, we are going to use a cash flow margin, or FCF, free cash flow margin, of 10.27%. Now they have confirmed as well that they will sustain growth in net free cash flow. Now they're 10.3, let's go with 10.3% free cash flow margin is again on the conservative side, because that's what they had. That's what their free cash flow margin was in 2023. So that's what we're going to use. We're not going to apply any growth to that margin, so we're going to keep it at that. So that gives us a free cash flow of 882 million euros for 2024. So we take that, and we apply in the discounted free cash flow model there. Now, as part of the model, I assume three cases: worst case scenario, normal case scenario, best case scenario. Now, worst case scenario, I'm going to assume that the business or the whole sector the sector size or Teleperformance's revenue is going to decline by 5% for the first 5 years, and then it's going to decline by 6%, which is extremely conservative, if you ask me. Shrinking your revenue by 5% a year or 6% a year is pretty significant, but that's what we're going to assume. The normal case, we're going to use the half point of their current growth, which is between 2 and 4%, even though the sector is forecasted to grow by 9-ish%. We're just going to say, you know what, we think it's going to grow by 3% for the next 5 years and another 2% for the following 5 years. Best case scenario, 5% growth and then 4% growth. First 5 years, 5%, second 5 years, 4%. And the weight of each case, now that'll make a bit more sense once I show you the spreadsheet there, the screenshot of the spreadsheet I used. But I'm going to say that there's a 40% chance that normal case scenario is going to happen, and then there's 30% chance worst case scenario can happen, and 30% chance best case scenario can happen. And last but by no means least, margin of safety. Now, I say I would like to be conservative. I would like to be, it's always better to be safe than sorry. So I used a massive 40% margin of safety, which should give us enough cushion if these assumptions here and these assumptions, all the assumptions are off target by a massive amount. So 40% is probably the biggest, unless you wanna, I wanna value like a super risky company, then I would say that 40% is probably as high as you would like to go. Otherwise, like the company of the price, the price of the company stock would be just too low. I mean, you will not find a company with a share price this discounted. So 40%, extremely conservative. So fair value of Teleperformance's stock, in my opinion, is 106 euros. And this is after, repeat, after the 40% margin of safety. They're currently trading at 99. They're still trading 7 euros below their discounted fair value price after 40% margin of safety applied. This is pretty incredible. That's very rare to see in the market. Again, it comes with its risks. You need to be aware of the risks, which is why I put them in the risk factors section, so you're aware with them. This is how we reach that conclusion. Again, this is normal case. I don't know why that's cut out. I need to fix that. But anyways, you can still read that. Teleperformance, normal case. Here's where we put in our free cash flow for 2024. Then we have normal case, best case, worst case. And again, 3% growth, 2% growth. Now, I'm not going to go over how discounted free cash flow works, and I'm not going to overanalyze it, but I'll just show you the spreadsheet. So when one day I put up a video about valuing a company with discounted free cash flow, I can go over that in more detail. But yeah, you can pause here. You can just have a wee look and see what that means. Or try to figure it out if you don't have any experience with free cash flow analysis and discounting free cash flow analysis, then it might take a bit of time. But yeah, my price is 106 euros. They're currently trading at 99.06. So yeah, that's pretty nice. So now, before we get into the verdict, let's have a look at the catalysts. What can trigger a sell-off or a stock price, or the stock price to jump? Near term, as I mentioned, that says 27 there, 28, sorry, that's 27. On the 27th of February, they're releasing their 2024 annual report. And they might have a forecast for 2025 that can share. So that can certainly affect their stock price. And a rise in allocate capital to their share repurchase program. Again, that will probably be released as part of their 2025 forecasts in a few days. Long term, sector growth, market share, size of the market share of that. Teleperformance is not looking at, but their market share. That's what I should have said. Improvement in their margins, certainly, or obviously reduction in their margins, which is going to go the other way. And new acquisitions, hopefully reasonable prices. We'll see. Again. Maybe in a few days they'll share some of the information they might have on their books on that. So hopefully it'll be a pleasant surprise. So do we buy? Do we sell? Do we add it to our watch list? What do we do with that stock? Well, my personal opinion is that there are risks associated with Teleperformance and the whole sector. Actually, it's not just Teleperformance. If anything, Teleperformance is the best choice is the company to go for from that sector. But there are risks, which I've mentioned already. But in my opinion, they're a little bit overblown, and I think they have affected their stock price too much. I think their stock price is oversold. As you can see, a company is selling for 7 times free cash flow. Come on, that's crazy. They're a record. Their P is at record lows. So that's, yeah, that's should tell you enough. But I think management. This company probably has the best management team in the industry. They are doing really well with allocating capital. As you can see, they're growing nicely. Their margins are improving. They are diversified in terms of geographical diversification. Um, the fears of a global recession, I mean, they are valid, I have to say, but the company's been in business for what, 47 years. I mean, they are familiar with recessions. They've been through a few and they've survived. They've come back stronger. So, yeah, I mean, the company has a lot of things going for it that I would argue are countering all those risks. So, yeah, would I buy it a certain at a current price? Absolutely. What are you talking about? With a 40% margin of safety, there I came up with €106 fair value for their stock price, and they're currently at €99. Of course, I'll buy it. As a matter of fact, I'm buying it today. So, but again, that's my opinion. I mean, don't do your own research. Don't just listen to me blindly and just go and buy it. I feel like I've spent enough time researching it. I think I've found enough information, and I like it. Good price, great company, leader in its sector. Yeah, it definitely has the thumbs up from me. Definitely. So yeah, I'll leave it at that. I appreciate your time. Thank you for sticking with me all the way to the end of the video. I hope you found value in this and you learned a thing or two. And I'll see you in the next video. Thank you again. Bye.